Let me grab my water.
Thank you very much, Eileen. It's always good to start with actual figures, as we heard this morning. John Lewis saying he prefers to work on actual figures. Okay, I'm now going to start the proceedings with a general question to the panel. And my first question is going to be to Justin Blend. You guys, just to refresh the memory, you do conversions, so you are developers in that sense, and you also hold stock, right? So you are landlords of residential stock. And the price range is about, or of the rental stock is about?
Call it 5,000 to 7,000 rand a month.
Okay, that gives us an idea where they are, right. Your vacancies, we saw here today, my figures showed it, and also Eileen's figures show it, that flat vacancies are the top 10%. What is your experience, your company's experience?
Very different numbers. Our vacancies currently are 3%. The worst they ever got in the middle of COVID were never ever worse than 10%. I feel that when you compare the general market to what the people on the stage, what we do today, you're comparing a CD player to a MP3 player. It's a different product altogether. Our numbers are so different and so much, I think we'll see better than what the average buy-to-let investor will experience. That it's almost worlds apart in that sense.
If you don't mind, I'll also chip in and throw.
Please do, yeah.
So I'm not going to shoot the messenger, but you did reference us obviously earlier in the discussion, and I suppose that's part of the challenge and part of the problem is that in terms of data that's available and having empirical data that I suppose portrays the space in the right light. It's not that there's a lack of information, but I think there's definitely been a lag in information. So you look at Transcend specifically, our vacancies sit at about 2 to 3%. Our arrears sit at about 1%. And I think it's also probably similar to the other large land property owners on stage with us as well. So
okay, just to refresh your memory, Transcend, you are into what segment?
So rental band, affordable, being between 4.5 up to maximum about 8,000 Rand rental per month.
Okay.
In terms of product, very much suburban type assets, residential, so your 2, 3, 4-story types of properties, but large complexes, so 200-300 units per complex.
Estates, sort of.
Yes, so estate living, and predominantly around the major metropoles on your corridor, your transport corridors, around places of work as well. But I think coming back to the fundamental issue is this: what information is available? And as we go through the whole institutionalization of residential, how do people make decisions, or what do they have access to? You look at Transcend, we one of 2 REITs where there is published information. You look at the information which you presented on stage earlier, and I think that there is a bit of a misconception that can be drawn based on what was presented and what was delivered. And again, I think when people talk to the actual performance, that will come through quite evidently.
Erwin, maybe if I could also just contribute to the occupancy conversation that we're having. The late Mr. Wapnick always used to say to me, Vanessa, if you're 100% occupied, your rent is too cheap. And if you're 95% occupied, your rent is too expensive. So yes, we aim also at a 97, 98% occupancy, very similar to the numbers that my colleagues on the left have been seeing. And that's realistic, right? But it also comes in at how you pose your escalations, which is your demand. And off the back of COVID, I mean, we went all into this sort of stale mode because we didn't know what was going to happen. So off of a very low base of 2021 impact impact with the pandemic, we've seen very good escalations off the back of that. So north of 5%. In fact, in some instances, we try and limit those escalations to 10%, purely because of the issues that you'll face with the housing tribunal, because it's sort of not fair practice to try and increase rents above that. So it really is a balance between those escalations and then obviously your occupancies.
Sorry, when did that extraordinary growth take place? Was it in 2022 or was it during the
So
pandemic?
we're starting to see that growth out of the epidemic. So
Out
from
of- okay.
2020, we stopped those escalations to try and keep the buildings full, which sort of stayed into the recovery of 2021. But now off the back of 22 and 23, we're starting to see those escalations.
Yeah, but we saw that with many property types, you know, it's sort of a catching up that was happening. Carl,
Could I
yeah.
just- Thank you, Erwin. If I can just add something, I mean, I agree with everything that's been said. That being said, there definitely is a heterogeneity in the quality of rental assets out there, right? So I know all three, the portfolios of my colleagues here who've spoken, and they're all absolutely excellent businesses. So it doesn't surprise me at all that their vacancies are well below 5%, and I'm happy to say as are ours. But the reality is that in our asset class, which is still certainly emerging and is still not very well, I can think, covered in terms of both analysts looking at the space, but also in terms of data availability, as Miles was saying now. There is a lot of, you know, there's the good, the bad, and the ugly, as there is in any real estate asset class. And I think in South Africa, the, let's call it institutional real estate investment landscape is very well versed in, for example, retail as an asset class. I think there are many people in this room here who could easily distinguish a great quality retail asset from a poor quality retail asset. And you see that in cap rate spreads as well. You know, there are retail assets that trade at a 200 or 300 basis point difference or spread in cap rates based on the quality of the asset, its location, where it is, who manages it, etc. And we are not seeing that in the resi landscape just yet, because frankly, there isn't the data. There actually aren't that many assets, really. It's still a fairly small market, but it is growing. And I think that a part of what needs to happen for the asset class to mature is that there needs to be this, I guess, greater sophistication in the market's ability to discern good from bad. Because I do think that there are, I mean, and the data, I don't think is wrong, factually. There definitely are portfolios in Eileen's data set that have seen very high vacancies in this period. And, you know, I will confess that, you know, we have owned some assets in downtown Joburg that were particularly hard hit and did see vacancies spike into the high teens, but they quickly came down again. And this is part of the story that I think, you know, we need to tell to understand the asset class better.
When you say good versus bad or mediocre, what makes the difference between good and mediocre? Is it the facilities, or is it the management, or is it both? And if it's facilities, what type of facilities do you guys typically put into your schemes in order to make it stand out, to differentiate it from the competition? Things like gyms, maybe, please.
Can I answer?
Yes.
Can you hear me? My mic? Hello? Just hello. You know, I said earlier, can you hear me? Hello?
Yes.
Guys. I said earlier, it's a different product we're offering everyone on the stage to regular, say, sectional title. The main thing is, when we say we own a few thousand apartments each, they're always in estates or a single building. And the differentiating factor is there's a single landlord, being ourselves, who control the entire environment. That has a huge positive impact if you're a tenant. Most importantly, I'd say, is noise. In my whole adult life, I've lived in an apartment. I'm sure many people here have lived in apartments. The biggest issue you generally have is the tenant next door is making a loud noise. You phone up the tenant's landlord, you say, your landlord, your tenant's making a noise, please ask them to stop. The landlord says, I can ask him to stop, but I can't do much more than that because I need his rental to pay my bond. And ultimately the noise continues. With us, we can control the environment, and we can make sure we can rather get rid of one bad tenant so the other 20 surrounding tenants are happy. And that's crucially important because it gives the tenants a comfortable place, a secure place to live. Then, in addition to that, what you're touching on now, we have beautiful gyms that you could cancel your normal gym membership because you can just use these plush work from home facilities that are nicer than our own offices work facilities. We employ personal gym trainers for free group classes. I think we all offer free Wi-Fi to our tenants, where if you're a sectional title owner, just free Wi-Fi, I'd say 600-700 rand in an apartment. You can't afford to give that. It will be 10-20% of the rental, but we can do those kind of things. So it's the whole environment that we're able to create for our tenants that makes us a different product and different category to just the regular what's currently available in the market.
That brings me to Palesa. Sorry. The DBSA also, you finance student housing. And that's one of the things that you could add to a student housing complex, of course, is these add-ons like Wi-Fi and a rest room or a computer room maybe, I don't know, things like that. Can you embroider on that?
Sure. Just to bring the funder's perspective, I'm a bit out of my depth here. When we look at I want to first tag on, please, to the question you asked around what makes a good project. We do fund developers and funds directly, but over and above that, we also fund intermediaries like your NHFC, as well as your TAFs, because they play in a space of the market where they're better suited, as opposed to us, where we look at your chunkier transactions. So while we push financial sustainability, I see one of my funders is here, Future Growth. We also have to pay back the money. So profitability, excuse me, is important, but so is development impact. So for us, location is very key, especially when one starts talking about student housing. Because if we find a project that's 10 kilometers away from campus, someone's going to come in with one which is a kilometer away. And students will riot for Wi-Fi. I didn't realize what a big thing that is. So connectivity is big, as well as social spaces where they can engage. What was interesting when you talk about vacancy is that even during COVID, the students opted to stay at home. And similarly, with our clients in the social housing space, we only had one request for a restructuring option, which was taken, and the loan then started to perform properly within 6 months. So we found the housing sector to be a very defensive asset class, contrary to what one would think, if you think retail, for example. So the sponsor, you need to be very comfortable with the jockey that you're backing. But again, because we are a development institution, we believe in funding emerging players, BE players, especially Black women. So Black women, please talk to me. We are struggling to find you in the market. But then what becomes key is partnering with people who've been in the game for a considerable period of time. Municipal approvals, also very important. I've already mentioned site. And then a good price point. And what's great with social housing and even student housing is that it's subsidized, right? On the social housing side, it's the consolidated capital grant that comes up front. And on the student housing side, we've got the NSFAS allocations that are collected over the 10-month period. So from a developer perspective, the risk is reduced from that perspective when you start talking about how do you fund your project.
Vanessa, you still wanted to say something?
Yes, I just wanted to pick up again on amenities. So specifically at House's vision, or more specifically Mark Corbett, was to be able to give the affordable sector a resort kind of living. A lifestyle that they would otherwise not be able to afford. So somebody could pay 6,000 Rand rent, and for that, other than high-class gyms with aerobic studios and cycle studios and weightlifting, indoor, outdoor restaurants that would deliver to your door, splash parks, water parks, beach bars, bicycle tracks, you name it, children's play areas, trampolines, swimming pools, free fiber, right? It really is a resort kind of living, and that was what we were aiming at. And again, because we own, control, and manage those estates, and because Century is our development arm, we're able to put those amenities within our estate to be able to give that to our tenants. So if for tenant retention and to be able to get escalations, that is the kind of product that you need to deliver.
I think that is really the essential point here, if I may. this last point of Vanessa's, I think, really is the essential point, because why, what makes a good asset? It's not the fact that you have a really nice pool doesn't really mean, there are certainly funders out there like the DBSAs of the world that I think have a developmental mandate and do look to what the other externalities are of what you're doing in the resi space in particular. But I think for most, pension funds who are the bulk of the capital providers to the space, at the end of the day, what they care about is return and the profile of that return. So the question really is, what is the pool doing for the return? And I do think there is something to be said for this kind of amenity offering that I think complements like a standard residential offering to the consumer that decreases the volatility of your income, essentially coming out of the assets, because you've got longer tenancy. Your tenants don't move out as quickly. There's some stickiness there. You're more able to put through rental escalations. And I think, to answer your question, Erwin, what makes a good rental asset? I'd say really an asset that produces a good income stream. And then the question becomes, what is a good income stream and what are the features of that asset that support that good income stream? I would say for someone that's doing 20, 30-year asset liability matching as a pension fund, low volatility in income stream and forecastability of that income stream is key. And everything that's been discussed here, I think, supports low volatility, forecastability of income streams. And if I can just add one last thing to this, if you look at, Eileen showed some data from the UK property market and how rental returns, resi rental returns compare there to the other real estate asset classes. But the same holds in the US, where 25% of the listed property sector is residential, and that sector trades at lower cap rates and has been doing so for the last 30 years than any of its other real estate counterparts. Why is that? Because consistently over decades, residential rental assets have demonstrated this low income volatility characteristic, and that's really valuable to pension funds. So that is a good asset, an asset that has low income volatility and that is forecastable.
But I think what's fundamental to all of this is...
I can't stress that enough. You can repeat that. Yeah. Carl, you can repeat that.
So, I mean, what everyone's touched on is effectively management.
Yes.
And again, when you look at our asset class, so yes, we all play in the affordable space, but what's interesting is that the 4 different portfolios at play here have different nuances. So you've got conversions, which is more of a smaller, more efficient unit. You've got our suburbans. Vanessa's is slightly up in the affordable bracket. You guys are more in a city, and it's horses for courses. So what amenity suits those complexes? What should be delivered to make sure that it is an efficient and optimal asset at the end of the day. But I think what it draws back down to is the specialist nature of the management and the team that looks after those properties and how you operate and own those properties at the end of the day. And if you can't do that and understand the tenant's needs, well, then you can't actually run an effective property or an effective asset at the end of the day. So, the one thing about residential is it's an ugly asset to look after. It's high touch, it's difficult. You've got to constantly understand the tenant's needs at the end of the day. So I think the backbone of this business is who are the property managers, what is the team, how close is management to the asset at the end of the day. And you asked about the kind of success of the formula of Transcend. We've got a full in-house property management capability where decisions are made immediately, information is fluid, and we understand exactly what we're delivering to our tenant base in line with their needs.
I must say, personally, I'm a chairman of a sectional title scheme in Durbanville, Cape Town, and the experience I've had with managing agents hasn't been good. But that's not a scientific statement because it's only one estate agency, although albeit a very old one. So I believe people who say that in-house management is better than necessarily out-house, if that is what you were saying by implication. Eileen, you were going to say something?
I just wanted to touch on what Carl was saying about institutional money flowing into residential as an asset class. We have seen that to a very limited extent in South Africa. We haven't seen a massive amount of capital from investors flowing into that asset class in South Africa. It's really been these guys on the panel looking more for that kind of investment and going out there and searching for it. If you compare that to the US market, particularly through the COVID period and coming out of that, there's been massive amounts of capital flowing out of the office market and out of the residential market, out of the retail market into residential because it's seen as a safe haven for capital from those long-term institutional investors because of that predictability of the income stream over a longest period of time. And I think South Africa, maybe we're just fledgling in that way, a little bit behind the curve, but I absolutely think that that's the direction we're probably going to move into as this asset class grows, because the demand certainly, I think, is there.
Melissa, you wanted to say something.
Yes, I wanted to add to what Aline is saying, quite right. Institutional capital is not flowing as much into resi. We've seen, though, and I suppose it's part of the nascency of the sector, that Regulation 28 has now increased the flows that can move into infrastructure funding. But I think what we forget is that we are specialized in property, but we're competing with a lot of other sectors as well, like energy, like road, like rail.
As it should, in fact.
Well, it's business, right?
Yeah.
And those transactions tend to be a lot chunkier than the ones that we look at. I mean, one energy deal can be 2 billion rand, you know. Whereas if I think of your portfolio, what are we talking about?
I mean, we've got one portfolio of 1,960 units, which is about 1.5 billion rand on its own. But the
But
exception.
that's consolidated, right? I mean,
No, that's one estate.
That's one
So
estate,
it's
okay.
unusual because we have
Yeah.
bigger estates. Our smallest estate is probably 400 units, and our biggest estate is 2,000. But like the likes of Transcend, you could have 150 units, then the market cap on that is much smaller.
Exactly. And with your institutional investors, they don't want to invest in lots of little micro projects. They prefer consolidated approach. And I think as a sector, that's probably what we need to start discussing, is how do we pool assets to be sizable enough that a pension fund can say, okay, I'll take 5% of that, because they're looking for that kind of scale to get the returns, because they've got these asset managers, right, that need to manage this flow of funds. So it's expensive for them as well. So if it's for smaller deals, it just doesn't make sense.
Can I come in here? Yeah, I can, of course. While talking about returns or initial yields or capitalization rates, whatever, what is a typical capitalization rate or income yield at which you can buy nowadays institutional type estates?
No, he was
Who's
going to
going
be
to
willing
go
to go
Do you have a
first.
feel for it? I know it's a trap. It's a trap. I know.
So there's the buyer's price and there's the seller's price.
Exactly.
Okay, you give me both, and I'll sort of take the median of it.
So look, I mean, if you're trying to sell something now in the market, I think it's probably sitting around about a 9.5% yield. That would be my best guess.
For a good quality asset.
For a good quality asset, right. If you're going to go sort of inner city, CBD, sort of very high rise, not well run properties, it's probably going to be north of 10%. But good quality, security estate kind of properties, I would say it's probably about 9.5%. What can you build it for is a different number. So obviously if you're building at cost, you more than likely could build somewhere between the 15% yields.
So Erwin,
So there is a profit margin still there for developers, in other words.
Of course, and if you sell it to somebody that wants to live in it, an owner buyer, you're selling it at 6%.
Yeah.
So when the economy is going very well and you want to, recycle your capital, you could take a portion of your assets and sell them into the market and really recycle that capital and replicate what you've done and double it.
I think this is the most important metrics you've just heard, guys. I hope you made a note of it.
But Erwin, I think there is opportunity for compression, definitely. So I think you can deliver at a certain yield and you can get decent value out at the end of the day. I think what it comes down to two things. It's the performance of the assets. So, I mean, you look at Transcend, and again, public information. We go through a valuation process on our portfolio on an annual basis. We revalued to just north of 9% on our rental portfolio.
How much? 9%?
Just over 9%, yeah. So that's predominantly what fits into our portfolio, and the price that I suppose you could attach, or the value you could attach
So are
to
these
our
estates?
properties. Yeah, so estates, suburban type assets. But again, understanding that we have a spread across Johannesburg, into Soweto, into Midrand, some in the Western Cape as well. So I think fairly representative of what you could achieve if you had to actually attach a yield to these types of properties.
So off the cuff, how would that compare with industrial capitalization rates?
I think it's fair to say that historically there's been at least a 200 basis point spread on a kind of like, let's say, quality like-for-like basis between industrial, retail, offices, which obviously have some differences between them, and resi. I think resi's been trading at a 200 basis point discount historically. And it's a difficult.
When you say a discount, are they lower or
Meaning
higher?
cap rates
Higher?
being
Cap rates
higher.
being higher.
Yeah. So if an office cap rate was 8%, the same quality residential cap rate I think would be 10% historically.
That's what historically
Yeah.
historically has been the case.
And the question is really, this is a difficult point in the cycle, I think, to think about cap rates, because there's clearly upward cap rate pressure in the other kind of real estate sectors. I think the crazy guys like us in the room that are swimming in the Kool-Aid all feel that our cap rate should be coming down, and we're in a high interest rate environment. So I think it's a weird point in time to be asking this question, which makes it tricky. But I do think historically there's been this 200 basis point spread, and I think my suspicion is that as the market matures, as there's more ability or like more knowledge in the market that allows asset managers to differentiate between good quality assets and less great quality assets. For the good quality assets, I think that spread will start compressing.
Before I forget it, before I get to Justin again, something which I forgot to ask or didn't get a chance to question. Speaking of facilities, better facilities, have you got any hard evidence that, or any evidence that adding facilities like, we mentioned a whole lot of it, that you could actually charge a higher rental for that?
Without a doubt. I mean, if you just look at rental growth over a period of time and our tenant retention, so how long you keep that tenant in that unit
Which
for.
is crucial.
That's all facts. The TPN would give national averages to say that 18 months is sort of the national average for how long a tenant must stay. I mean, Transcend alone is sitting north of that. They're about 27 months now.
Yeah, we're just over 2 years.
Yeah, and likewise for house, we're sitting at 2 to 2.5 years that tenants are staying in the developments. So those are all prime examples. And even, for example, having a load shedding solution. How many flats can you go to where you can have your lights always on during load shedding, you can have your internet going, and you can cook on a gas hob. So offering those kind of facilities, of course you're going to be able to keep your people, and then which means you can also get your rental growth.
As a matter of interest, do you sign 1-year leases like the rest of the industry, or is it longer leases you try to sign?
Sorry, repeat your question.
Do you sign 1-year leases like the rest of the industry? Do you sign longer leases?
So we work a little bit differently. Transcend and ourselves, we have month-to-month leases. There's absolutely no value in a residential sector to sign a 12-month lease. It only benefits the actual occupier. So in a situation where there is non-payment of rent, we can terminate that lease with 30 days notice, and we don't have to prove breach. And that doesn't just apply to somebody that doesn't pay their rent. If somebody misbehaves or causes trouble, we can terminate their lease with immediate effect. Of course, you can stay as long as you want to. There's no reason for us to terminate your lease, and that's why we get people that stay with us at least 2.5 years as an average.
Yeah, the point is people will typically leave when they leave, right? And the lease is almost immaterial. As a matter of fact, with the Rental Housing Act, you can legally as a tenant give notice for 30 business days or the 20 business days.
21 business days, yeah.
So it's a month-to-month business model.
I find that very interesting because I grew up in a regime where the longer the lease and the better the lessor, the lessee, the lower your cap rate.
Is that the same for hotels?
Yeah.
Yeah, we had to educate the JSE on that, because when we tried to list, we had to prove contractual income.
Yeah.
So we had to really go to the JSE. It doesn't apply in the residential space. Look at the history of our income, and that is evidence of how stable our income is. It's not the contract.
With that said, I think maybe we should all just touch on the average tenant in our portfolio, because that comes down to stability of income and therefore yields going down. For us, our average tenant is about 30 years old. They earn between 20 and 40,000 rand a month after tax. They generally have either a university degree or diploma, and they work either for a corporate or government. So they're very, very stable tenants. They're not, when people hear affordable housing or middle income housing, they think low income housing. This isn't low income housing. It's a very, very, very stable, educated tenant, and they're paying the rent. And we find if we lose 1 or 2 tenants, we replace them within a few days, weeks, worst case, by the end of the month, they're replaced. So someone asked me recently what keeps me up at night in the business, and I was thinking I actually never had a good answer, because there's such huge demand from tenants for our type of product, all our products, that we're not. If you own an industrial property or a retail center and you lose one big tenant, you've got a big problem. Here, you lose a tenant, you don't even blink an eyelid, because the next day you get another tenant, and that's stability of income, and that's what's crucial.
And sorry to hammer on it again, what is a good product?
A good product is
already
how he
discussed
described
it.
it. Good product means good income. What does good income mean? Stability of income. And if you've got so much demand, your income is always stable.
But that starts with a good tenant, by the way.
Yes. But that's where the in-house property management comes in. That we've got all the institutionalized methods of checking if a tenant's good or bad, and only letting in good tenants, and also being able to control that environment. So it all goes hand in hand.
So I was really just going to reiterate what Justin's saying, and I think one of the problems that the institutionalized sector has when we compare this to a to a retail and office, where you're looking at, 3-5 year leases, that 1 year lease term in a valuer's mind or in a bank has become something that they've had to really grapple with and change their mindset around that in a very big way, to understand that income is as stable as a 3-year lease. And actually what it gives your management team the ability to do is churn and move very quickly in the cycle. So they're not stuck with leases where the tenant's actually vacated and not paying, and they've got to, they're able to quickly keep that income stream moving, which creates that stability. It's just flipping everything on its head, which I think that the institutionalized market in South Africa hasn't quite got their head around yet. Yeah.
Self-storage is a similar case. Self-storage, also month to month. And it works very well for them.
No, I agree with you, Eileen. I think the challenge is the mismatch, right, between the tenure of the facilities that you will get from a bank. I think your typical commercial banks will give you 5 to 7 year money. We can go up to 15 years, 20 at a push, and then you come to me with 1 year leases. And it's this fear of how you're going to service that debt when you don't have similarly long-term leases, to match against that loan profile. But I think we're getting better, because as you mentioned, if you've got the historicals to back the performance, we are more reactive now in terms of looking at that, assessing that. And again, this is where the experience of the team comes in, where you've done this for years, you know the market, you know how it behaves. And the trust then is not even so much in the tenant, it's in you and what you do in terms of your business. Why I actually initially put my hand up was a question that I had around affordable housing. It's such a huge umbrella, because you talk about 20 to 40,000 of the tax. In a South African context, that surely can't be affordable. When we talk with our clients, are looking at about a 3.5 to 22,000 after tax bracket. So are you guys still in affordable housing?
We fall within the definition. That is a definition. Yes.
Yeah, so it depends on which market you're in, right? So it's affordable in terms of the context of where you're aiming at. So there's affordable for Sandton and there's affordable for Soweto. So our rental, specifically at House, I would say is on the top end of that affordable. People pay rent between 6,000 and let's call it 10,000. It's just over 10,000. So as a family, husband and wife together need to earn about 18,000 Rand to about that 40,000 Rand mark. So for us, that's the affordable market.
So single moms can't get it?
It depends what they earn.
But I think that pool's growing. So I think, you got to also kind of reset your mindset and the parameters to what is affordable. Having a very narrow definition in terms of between 7 to 20, you've got to look at where the growth and where the demand for quality affordable housing also lies. And I think it is broader than that. I think it's very much a low to middle income gap where this problem and this disconnect between supply and demand actually sits. And again, I know that, in terms of mandate and what people can and can't invest into, maybe it is a more narrow definition that they have to stick to and that they're limited to. But I think when you look at the bigger problem, this demand sits across a much, much broader market and a much bigger group of people at the end of the day.
And if I could just add to that. So I think our business probably caters to the lowest segment of the market of the businesses represented here.
And then us.
Yeah, and then you guys.
Which is about
But
4 to 5.
Our rentals in our current portfolio are about 4 to 6,000 rand
4
a
to
month,
6.
4 to 7. And I'll give you an example. We're doing a project in Sandton at the moment, just literally down Catherine Drive here, called Barlow Park. That's currently under construction, and that'll be 1,600 units renting for between 4 and 7,000 rand a month, and that's a product in Sandton, and I'd call that probably, by most definitions within the affordable housing market. Having said that, I do think that a challenge that we have as an industry is this term affordable in the context of affordable housing, because it is a bit of a, I think it does signify risk where it isn't necessarily there, and I think a more useful, we as a sector need to collectively, find a term that, as much as in the US it's multifamily, and when you say multifamily, everybody understands what you're talking about. And it's also understood that within multifamily, there are obviously different kind of segments of the market in which you play, just as there is in offices, A grade, B, B grade, A grade, B grade, C grade, etc. And we don't have that in the resi space yet, and I think, again, it's just a fact of a case of the asset class not being very mature yet, and the market still learning how to kind of understand it.
Which brings me to another question, and that is, in the commercial sector, you express rentals per square meter, and it's always amazed me when I got into the property market zillions of decades ago, that in the case of flats, you express rentals not per square meter, but for bachelor and 1 bedroom and 2 bedroom, etc. Internally, do you guys use rentals per square meter to guide you?
No, never.
So I think at the end of the day, you're looking at utilities. So what am I renting? A 1 bedroom, a 2 bedroom, a bachelor, a 3 bedroom apartment. And that number or that rate per square meter can often be skewed depending on the size or what it is that you're offering, or the market or location that you offer that product at the end of the day. So, coming back to the point that was made earlier, I think by yourself and also by John, is affordability in our market is obviously key and critical in terms of how we tenant up our buildings and who the market is that we're trying to tap into. And people will generate X amount per month and therefore can only afford Y worth of rental every month. So looking at it on a rate per square, it's a nice sanity check. It's great to have, but I don't think it's the overarching
especially
requirement.
when you compare it with competing asset classes, like offices or industrial or whatever.
There you should rather be looking at bad debts,
Yeah.
occupancy level.
And I think this is, again, part of the issue and part of the problem is that trying to paint residential with the same brush isn't necessarily the answer. I think we behave very differently as our own asset class. I think we've kind of unpacked the risk profile that sits behind our asset class as well. And again, the misconception that affordable or residential is risky, which, again, looking at the income streams and the performance of the portfolios on stage, it isn't necessarily the answer. I think it's anything but risky. And, trying to shoehorn residential, although those are important benchmarks, I see us as being an investment alternative in the property sector. It's not necessarily to squeeze us into the same space to say, oh, but you must be the same as commercial, and therefore we will judge you or measure you on the same metrics or the same KPIs. I think it's understanding exactly what it is that we have to offer as an asset class, and those are the things that are going to enable capital to come and help, I think, our sector grow over time.
I'm not convinced. I must say, I would prefer that one introduces, in addition to your current measurement metric, that you also introduce rentals per square meter as an additional. It could open up interesting truths if you were to do that on your own portfolio.
Sorry.
Maybe I can quickly just say something on that. So office 250, 300 rand a square meter, our residential 100 rand a square meter. So what conclusion can you draw between that? That we a cheaper, worse product, or we don't perform as well? I don't think that that's necessarily the case.
No, but you can't compare flat buildings with flat buildings. That's a direct way of
The problem is amenities. If you got a
Yeah.
400 square meter gym and a 300 square meter work from home.
Well, in
where
offices,
does
we've
that
got
come
grades
in?
A, B, and C.
Yeah. So
Anyway,
we don't sell our product on a per square meter basis.
Yeah.
So you
I
don't
know.
sign up a contract to say you pay 130 Rand a square meter. You pay 6,000 Rand for a bachelor unit. And because the driving factor to the tenant is on a per unit basis.
Yeah.
So if somebody's going to live there, 10 square meter means nothing to them. They're going to look at it and say, how does it look? How does it feel? What amenities? And they're going to go next door. How does it look? How does it feel? What amenities? And they're going to make their decision. They're not going to do it on a per square
I fully
meter
agree
basis.
with you on that one. That's why it's so in the first place. I was just thinking aloud that for researchers it would be an helpful additional metric. Are we running out of time? Or have we
We've
run
got
out
a
of
few
time?
questions, which was actually posed on the WhatsApp group that I'd just like to pose here first. We do have a bit of time, so we just want to involve the audience a little bit more and get them sort of to ask their questions. So I've got here from Sangha, he's saying, what is your advice to someone starting on their real estate investment journey? Where can not afford to purchase or get the financing to build large residential buildings? So is there a risk in the long term of semigration from place? And so it's a second question, such as Joburg to the coast, given the work from home, better management in municipalities, the Western Cape and lifestyle. Who wants to have a crack at either one of those? I mean, I'll put it out to you.
I can take the first
Felisa, right.
I can take the first one. If, like me, you don't have money, I would say go into social housing first. The department gives you...
That's right. This is turning into a nice debate. So
It's a numbers game. The department gives 70%. As a funder, we look at that as your own equity contribution. We give you the remaining 30%. Granted, as an SHI, which being a social housing institute, you won't own the structure, but I don't think you need to. It's a non-profit company, but you just own the whole value chain from facilities management to security, and you expense it. You save that money, and then you graduate to another delivery agent where you can be profit making, and then one day you're transcend. That's how I would do it.
okay, great, perfect. Vanessa, you wanted to add to that. You got your views.
So if your decision is purely related around funding, then of course getting a government grant is going to get you most of the way there, right? But the social housing, and we're not here representing social housing, the other panels will talk to that, but social housing is its own kettle of fish. You've got to understand this is a different asset class. Yes, it is rental and it is residential, but you're dealing with a very low-end market and you're dealing with a lot of regulation and compliance issues. So it's not easy. It's very, very difficult, first of all, to convince SHRA to accredit your project, number one. And number two, the management of that social housing fund is incredibly difficult. You need to educate the tenant. You need to tell them what is a lease, when you need to pay your rent, how to get utilities. It's a completely different ball game. So yes, it is possible, but it's very hard.
I think
Great.
on the semigration question, and you know, these markets shift. So a Joburg market today might be different to a Joburg market tomorrow versus a Cape Town, and where I suppose, you know, the different peaks and troughs sit across a for sale or homeowner market versus a rental market also vary through the cycle. And I think you need to look at it in context of, you know, a much longer period of time and tenure as opposed to just a point in time. Joburg, yes, maybe in terms of home ownership and capital value, slight drop off, but what we've seen recently is the rental demand has picked up increasingly. And because the rental demand's picked up, your buildings are full, your escalations are higher, your performance is better on that side. Cape Town, you know, less product, less supply, more demand, potentially a better for sale market, homeowner market at the moment, just because there isn't much that is actually trading around that side at the moment. And there has been some migration in terms of people moving from Joburg down to obviously the Western Cape as well. So I think when drawing conclusions, again, you've got to take it into context as through the full residential cycle and over a much longer period of time. But you have these shifts, and I suppose if you're delivering a quality product, you'll have optionality and flexibility to move between those two markets and utilize or own your product in the right way.
Great. I think, if you just look in Cape Town, talking to a lot of agents and brokers, they say there's almost 15 to 20 people for one rental property at the moment. So there's major demand. But people still need a place to stay here in Johannesburg. And we're starting to see it's picking up, which is good news. So it's a robust market. Okay, another question. It's from Motsamai Mofa King. From Amendo Town Planners, has the private sector and funders looking at funding the human resource by deploying experienced personnel to technical sections of municipalities so that they could plan better infrastructure and approve plans urgently? Most expertise is sitting with private sector, and municipalities have high turnover. Deployment of employees in these municipalities should be paid by private sector, and there will also be skills transfer, and with this, economy can grow and more jobs opportunities could be created. A thought of the contributions to the sector. So I just want to add to this piece, because I want to ask your comments now, because in the Western Cape, and it's a very similar forum to this, they have the Western Cape Property Development Forum, and at the forum it's very common to have all the mayors from all the different towns sitting over there, and they've been benchmarked and said, if we put in an application for a development, what is your time that it goes through? And then they say, well, it's 2 weeks. And I say, that's not possible. Okay, it doesn't necessarily happen on the ground in 2 weeks, but at least they've set themselves the benchmark, at least to respond, that it doesn't get lost in the in-tray. So maybe just your comments in general just on that, because we'd like to get that same thing going right here in Johannesburg. Thoughts? Anybody? I see Vanessa wants to.
No, sorry, I'm speaking a lot, but it's
No, it's
not
fine.
necessarily on the development side, but more, you said what keeps you awake at night. It's not trying to occupy and keep our buildings full. It's not getting escalations. It's not giving our investors and shareholders the returns that they expect. Those things we can manage. It's council. What keeps us awake at night are specifically the city of Johannesburg. So if there's anybody here that has influence over that, please. And I think I speak for everybody that owns bulk property. It's one of the biggest hurdles that we face is our utility charges.
But maybe on that as well, I think having a clear plan from council is obviously helpful. And I think at times in Joburg and Gauteng, the plan isn't necessarily, or the long-term plan isn't necessarily always clear or as clear as Cape Town. And then I think it's also to understand, so in terms of the market and the housing market, who does it impact? Who does it affect? So these things, municipal charges, tariffs, which sometimes are passed on to tenants, which obviously inhibit our profitability at the end of the day as landlords. That's not affecting just our tenants. That's affecting their families. It's affecting the job market. It's a much bigger pool of people that actually get impacted by these sorts of inefficiencies. And I think if council and government can understand that better and perhaps unpack that in detail, then maybe there'll be a bit more propensity for them to support certain things that can help us operate going forward.
Perfect. Okay, do you want to say that, Justin?
I'll also add, so I agree 100% with what everyone said, but also in terms of rezoning, because there is a housing shortage. So in the cities or even Sandton CBDs, people aren't occupying the office buildings as much. The properties values are going to come down. This is commercial property, and councils therefore going to collect less rates in taxes. If council, what we're seeing around the world is cities are giving incentives to developers to rezone properties. They're not charging as high. In Johannesburg, the fees and the costs to rezone are extremely exorbitant. If the city came to the party and actually encouraged developers to rezone and build, maybe rates relaxation while you're developing, things like that, there would be a lot more development, and it would actually benefit the city ultimately, because there'd be a lot higher value properties, and therefore that collect a lot more rates in taxes.
But even funny little things, like aggressive tax incentive, you look at 12Bs now. So solar, we've got an electricity crisis in the country. Well, we've also got a housing crisis in the country. So, you then qualify for 125% write-off in year one if you deliver product. There's a whole lot of empty buildings sitting in Sandton or wherever it is in terms of commercial. So I wanted to ask John earlier, are there murmurs of these sorts of things being rolled out from government or from the tax regulator to say, okay, guys, we're going to incentivize you to actually fund these products or these sorts of projects to get this up and running so that we can deliver on scale. And Justin's right. Those are the things that if you give incentive and you make it easier, then you'll see, I think, the large-scale delivery that we want to see.
Great. Okay, what I'm going to do is I'm going to go around to each one of you just to close off. But I'm going to just go through some questions which are unanswered. We're fighting with time between you and obviously refreshments. So I'm just going to read a few of the questions, and you can comment, and then maybe just give some of your closing thoughts, your ideas. One question here, are the panel finding that the millennial generation opting to rather rent than buy their own property? Okay, that's one particular one. And then we've got, what is the risk of increasing rental in this difficult time where interest rate is hiking? Which, well, we know what those are. It's a lot of sweat, isn't it? So what is the, okay, that's on the interest rate side. And then, quite important question, what is the view of the panel around transformation of the sector, and is enough being done, and how serious are we? And so that's a comment over there. And then to the development panelists, what is the impact of these ever-increasing repo rates and model? So maybe just, incorporate some of that thinking. Starting with you, Eileen, maybe we're going to go around, right? And then ending with you, Advin, your final thoughts, your final comments to the audience.
So I think this is a sector that we're going to see grow, because things like increasing interest rates are definitely going to put that segment of the market or sort of prohibit them from buying. So in a market where we've tended to aim to buy houses, it's opening up that rental segment a lot more, which is probably a good thing. And I think if we start seeing more capital flow into the segment, so the institutionalized guys starting to come in, and we have our sponsors, so APS are sitting in the room. If we look at the data set as we've started, that can only grow, and we can start to solve some of the issues like getting language that is equitable. Do we want to talk about affordable housing? Maybe that's not the best term. Maybe we want to start splitting things up. But as the sector grows, we're able to do it more and more and measure it better, and therefore give the investors what they need, whether it's a rand per square meter rental number or a per unit number. What do people need to make those best decisions to let that capital flow into the sector? But I do think that sector is going to grow, and we're primed to do it.
Great stuff. Eileen, Andrew, thank you very much. Pelisa, your final comments?
Yeah, no, I think Eileen covered it well, especially in terms of us being in an interest rate rising cycle. And I don't think it's necessarily specific just to millennials wanting to rent. People are downscaling. Our earnings are far being outstripped by the cost of living. I hear inflation is 6.4? I don't know where that is 6.4, because my grocery bill says otherwise, And in terms of transformation, definitely we aren't doing enough in the sector. If you look at the demographics of our country and the representation, one, whether it's from a women perspective or secondly from a people of color perspective, you don't have proper representation, especially at the higher end management level, the ownership level. And I think it's a function of, you talked about education, for example. I think it's a function of people being exposed, people knowing what the opportunities are, because I don't think it's just a matter of throwing money at it, but I think it's opening up the sector and educating people, and then coming up with the concessionary funding, not necessarily just grants, to get people to start participating.
Great stuff. Vanessa, your final. If we can go quickly, time is running out. I know everybody is, with the refreshments are being served. Melissa, your final thoughts?
Yeah, so definitely the youngsters these days are getting married later, having children later, and want flexibility. So 100% they opt for rentals. My own children, 24, 22, so I know what I'm talking about there. And then, of course, on the interest rate environment, the two don't necessarily run in parallel. In a high interest rate environment, people can't afford their bonds, and so then they rent, which means demand increases, which means we get better rental. So, yeah, in a difficult economy, rental is definitely on the upside.
Great stuff. Coral, two final words?
Yeah, definitely support what Aline is saying around the asset class growing. There's over R1 trillion of rental property in South Africa. 40% of South African households rent. Unless South Africa is fundamentally different to most other developed capital markets, this asset class will also over time come into its own as institutional landlords like you know, those represented here, I think, grow their businesses and assist in kind of educating the market around the asset class. But a core thing that we need is good data. So to all of the rental landlords that are in the room here, if there are of you who are not contributing to Eileen's data set at MSCI, please do consider doing so, because it's definitely part of what we need to do.
Great. Miles?
Yeah, I think at the end of the day, what we actually deliver on is a fully or truly sustainable asset class. So you look at transformation, you look at representation, and I think in terms of, again, the affordable housing market there's a big social element that's attached to that. The environmental one, yes, when you build something and deliver that to the market these days, the environmental considerations are paramount and I think are inherent to any sort of building. But I think what is often undervalued is the social element that gets overlooked. And in terms of our portfolios and what we do, I think we definitely tick a big box on that side.
Excellent. Great. Thank you for your rep. Justin?
For me, closing off, can you hear me? I speak to a few CEOs in America and Europe of big residential listed funds. And when I speak to them, I get very excited because it's like speaking to the future. I believe South Africa will always follow, you know, where they ultimately are. And their message to me is always, Justin, be very excited because this asset class is going to explode. It's going to be huge. So, yeah, it's a very exciting future we're looking forward to.
Great. Evan, your final words.
Yeah, no, I firmly agree that in the long term, this is a growing asset class. South Africa, for I don't know whatever reason it is, but we have been lagging the rest of the developed world without a doubt. I mean, to give you an idea, in Switzerland, about 60% of your households rent. In Germany, it's 50%. I don't know what the percentage is in the Netherlands, but it's also very high. And I understand the UK is also very high. And unfortunately, it's difficult to directly compare South Africa's statistics with those developed countries because of our very strange society. As many years ago, there was a book entitled this, South Africa, a Strange Society. It was in apartheid years. You know, just for starters, about 50% of our people don't have jobs. So how do you compile these statistics? How do you compare? You can't really. But certainly, I think as housing becomes more expensive, and which has been happening all the time in any event over the decades, so that's not new. So maybe I shouldn't use that argument. But certainly, as our incomes in the real terms keep on dropping, and I think that is a long-term trend that's here to stay. There's no doubt that people will look for shorter, for lower expenses for housing, lower housing expenses, and of course renting is then the obvious one. The problem there is, of course, now comes retirement, and you haven't got an asset, but that's a different question completely.
All right, on that note, we close off the session.